S1. Hook plus disclaimer right now. Approximately 9 million Australians are paying for life insurance every single month. Most of them have no idea. It is coming out of their superannuation. Automatically, silently, and according to a Finder survey, 43% of those people could not tell you how much cover they have. That is not a small thing. If something happened to you tomorrow, an accident, a serious illness, a death, that insurance could be the difference between your family keeping the house and losing it. But here is the part most people get completely wrong. There is a catch built into how super insurance works. A legal catch. And once you understand it, you will never look at your super the same way again. We are going to cover exactly what your super insurance includes, what it does not, and one specific piece of information about TPD cover that Australians genuinely do not know. Before we go any further, this video is for general educational purposes only and does not constitute financial advice or insurance advice. For advice specific to your situation, speak to a licensed financial advisor. Alright, let us get into it. S2. What cover does super actually include? Most Australians do not know that their super fund is also an insurance provider. Here is what is typically included automatically. First, death cover, also called life insurance. If you die, your super fund pays a lump sum to your beneficiaries. How much? We will get to that, and it might surprise you. Second, TPD cover, total and permanent disability. If you become permanently unable to work due to illness or injury, this pays a lump sum. Again, the amount matters, and there is an important catch we will cover in a moment. Call to action. Third, some funds also offer income protection insurance, a monthly benefit if you are temporarily unable to work. But that is separate from death and TPD cover, and we have covered that in another video. Link in the description. Now, there is a catch about who automatically gets this cover. Since the government's protecting your super reforms in 2019, you need to be at least 25 years old and have at least $6,000 in your super account, and have made a contribution in the last 16 months to have cover applied automatically. If you are under 25, you need to opt in. Your super fund will not automatically give you cover. This is one of the most overlooked gaps in young Australians' financial lives. If you are under 25 and watching this, check your super fund today. S3. Is your default cover enough? Here is the number that most people do not check. How much are you actually covered for? The default death and TPD cover in most Australian super funds sits somewhere between $100,000 and $200,000. Call to action. That sounds like a lot. But here is the context. Financial planners generally recommend life insurance coverage of somewhere between 5 and 10 times your annual income. For someone earning $80,000 a year, that is $400,000 to $800,000. At the low end of default coverage, $100,000. Most Australians are significantly underinsured. Now, whether you are underinsured depends entirely on your personal circumstances, your income, your debts, your dependents, your other assets. That is a conversation for a licensed financial advisor. Not this video. What I can tell you is, if you have never looked at what your super fund covers you for, now is the time to check. Log into your super account, go to insurance, and see the number. The number might be fine. It might not be, but you should know it. S4. TPD. The Any versus Own Occupation reveal. This is the section most Australians have not heard about. When your super fund gives you TPD cover, total and permanent disability insurance, there are two different ways that coverage can be defined. The first is called Any Occupation TPD. This means, to make a successful claim, you need to be permanently unable to work in any job suited to your education, training, or experience, not just your current job. Any job. The second is called own occupation TPD. This means you are covered if you can no longer work in your specific occupation, the job you actually do. Here is the critical thing. All TPD insurance held inside superannuation in Australia is any occupation by law. Super funds cannot offer own occupation TPD. This is the law under Australian superannuation regulations. Let me make this concrete with an illustrative example. This is not a real case. Imagine a surgeon who has an accident and can no longer perform operations. Their hands are too affected. They cannot do surgery anymore. That is devastating. Under own occupation TPD, the surgeon would likely qualify for a claim because they can no longer perform their specific role. Under any occupation TPD, the question is different. Can this person work at all? Are they educated? Do they have experience? Could they theoretically work as a medical consultant? A teacher? A university lecturer? If the answer is yes, they may not meet the threshold for an any occupation TPD claim. This is not saying super TPD cover is bad. It is saying, this is how it is legally structured. The any occupation definition sets a higher bar for claims, and most Australians do not know that is what they have. If you want own occupation TPD cover, it is available, but only outside of superannuation, as a standalone policy. Whether that is right for your situation depends on your occupation, your income, and your personal circumstances. That is something to discuss with a licensed financial advisor. The key takeaway: know what you have. S5. Where does your super go when you die? Here is the second thing most Australians get completely wrong about their super insurance. Super does not automatically form part of your estate when you die. It sits outside your will. That means your super fund has discretion over who your death benefit goes to, unless you tell them exactly who you want it to go to. And even when you do tell them, that instruction needs to be the right kind. There are two types of death benefit nominations. Call to action. The first is a non-binding nomination. You tell your super fund who you would like to receive the benefit. They note it, but when you die, the trustee still has discretion to override your wishes if they decide someone else should receive the benefit. That is a real problem if you have complex family circumstances, an ex-partner, blended families, estranged relatives. You might think your super is going to your children. The trustee might disagree. The second is a binding nomination. The trustee must pay to your nominated beneficiaries. No discretion. Your instruction is binding. There are two types of binding nominations: lapsing and non-lapsing. A lapsing binding nomination expires every 3 years. Many Australians set one up, forget about it, and then it lapses, leaving them back in non-binding territory. Always check yours. To make a binding nomination, it needs to be in writing, signed, dated, and witnessed by 2 independent adults who are not beneficiaries. One more important thing: you can only nominate your legal dependents, your spouse or de facto partner, your children, or someone financially dependent on you, or your legal personal representative, which is your estate. You cannot nominate a friend, a cousin, a colleague who does not financially depend on you. Call to action. And there is a tax implication worth knowing. If your super death benefit is paid to a non-dependent, an adult child who does not financially depend on you, for example, it may be subject to tax. Paid to a dependent, like a spouse or young children, it is generally tax-free. If you are thinking about how your super death benefit fits into your broader estate plan, speak to a financial advisor or an estate planning professional. This is the kind of thing where getting it right matters, and getting it wrong can cause real problems for the people you leave behind. S6. When to review your super insurance life changes. Your insurance needs to change with it. Here are the moments that typically mean it is time to review your super cover. When you get married or enter a de facto relationship, your financial picture has changed. Your partner may now depend on your income. When you have children, your default cover of $100,000 to $200,000 may not come close to covering the cost of raising children without you. When you buy a home or take on a mortgage, your death benefit should at minimum be able to cover your debt. When you separate or divorce, you may need to remove a former partner from your nomination immediately. When you change super funds, your cover with the old fund may end if that account becomes inactive. Do not assume continuity. When your income increases significantly, if your salary has grown but your cover has not, the gap between what you have and what you need has widened. And when you turn 25, if you have not already, because that is when you first qualify for automatic cover, you do not need to review every year. But reviewing at major life milestones can make a significant difference. S7. Compare your options if you have done the exercise. Checked your super cover. Looked at the definition of your TPD insurance. Reviewed your death nomination. And you think your cover might not be enough. The next step is to look at what standalone life and TPD insurance costs. This video contains affiliate links. If you click through and arrange insurance via our links, we may earn a commission at no cost to you. Call to action. Compare the Market is a comparison platform where you can look at life insurance and TPD options from multiple providers side by side. I have linked them in the description. These platforms let you see what is available at different cover levels for your age and circumstances. They are not giving you financial advice. They are showing you options. For advice on what you actually need, talk to an advisor. S8. Close plus disclaimer: 3 things to do after watching this video. 1. Log into your super account and check how much death and TPD cover you actually have. 2. Check the type of nomination you have on your account. Is it binding or non-binding? When does it expire? 3. If something does not look right, speak to a licensed financial advisor. This video is for general educational purposes only and does not constitute financial advice or insurance advice. The information in this video is general in nature and does not account for your individual circumstances. For advice specific to your situation, speak to a licensed financial advisor or visit ASIC's MoneySmart website at moneysmart.gov.au. Call to action. If this video was useful, leave a like. It helps other Australians find it. And subscribe if you want more straightforward breakdowns of how Australian super and investing